Welcome to the trade of the week. This week we're gonna do a trade in gold. If you're like me and you see a chart like this where gold just skyrocketed to the top of the world, you get something called FOMO, fear of missing out. And if you're like me, I had some gold around here, around the 160s, and I sold it around 167. And it was a very dumb move. Now I want to get back in. And looking at this chart, we first have to see what level we would be willing to buy gold at. In my case, I like somewhere around here, maybe 175, 74, something like that. And but I don't want to pay these crazy prices of 188, 192, 194, etc. So let's see if we can find a trade in gold that will allow us to get long gold at our target price without paying more than we need to. I love the Tastyworks platform. It's the easiest platform to use. Let's go to the trade page. I normally like to use monthly expirations, so September, October, and normally I like to find 45 days to expiration. Unfortunately, right now, the 45 days is a weekly expiration, so I'm going to see if we can find a trade in the September expiry. The Tastyworks platform gives us this shaded area where we can see that the expected move of the underlying will be during this period of time. And it's very similar. Remember the area we were looking at, the 174.75? So this is the area where I want to get long gold in the next pullback. So the first thing that I do is sell one time the 175 put. Then I look for a higher put that is double the price. And normally I like round numbers. So I would buy the 350 price put, which is the 180 strike. And what do we have? We have a long put vertical that we're long the 180 put and we are short the 175 put. But this is a debit trade, and debit trades are not normally good trades. So how do we convert this low probability trade, which is right now, if you can see here, it's only a 37% probability of profit, into a more profitable trade? Since we don't mind getting long gold at 175, I click a second time on the 175 strike, and I would add another option. And what do we have now? So we're long 180 put and short two 175s. If we're short two 175s, that means we are currently naked one of the 175 puts, and we would get long here. But let's take a look. If you are a graphical person like me and you like to see images, there's nothing more clear than this. So here is our trade. Here we can see we're buying the 180 put and we're selling two of the 175 puts. So the green area shows us where we would make money. And also the 175 is the place that we are willing to take possession of the GLD underlying. But take a look, there's something very curious. We won't lose money in this trade until we reach 170. Why is that, you may ask? Because the distance from 180 to 175 is 5. So if gold goes down, actually we will make these $5 profit. And of course, we will lose money on our naked put, but the money we're losing is compensated by the $5 profit. That's why 175 plus 5, we will not lose money unless gold is below 170. And I love to do these ratio spreads to the downside, and they're beautiful because if gold goes up, then we make only 17 cents. And if gold goes down a little bit, let's say to the 175, we make $5. And if gold goes to 165, well, we didn't mind getting long gold at 175, but actually we are going to be long gold at 170 because of the 175 plus the $5 profit that we would have here. You can use this type of strategy on any position that you want to get long in. And also, as a further bonus, if you have a long position, let's say in gold here, you can use this position to protect for a small down move as well. Now, let's hope and see what happens next week with gold. As you remember, in our week in review, we saw that gold had around a 6% down week. If gold goes down 4 or 5%, this trade is going to be a very, very nice winner for us. And hopefully, gold will give us a chance to get back in, because I think gold is one of the things we need to have in our portfolios because the Fed is printing so much money, they're devaluing the currency, and these type of positions will protect our portfolios from the devaluation of the US dollar. Once again, I'd like to say that these are not trade recommendations. Trading derivatives are risky. And let's see next week if we can review what happened to this trade and maybe make a little bit of money. Alrighty. Thank you very much for watching the trade of the week in gold. And remember, you gotta risk it to get the biscuit. Thank you for watching, and good luck trading next week.